This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, he still owes me money from that dice game back in 21. It's Rob Reinhold.
Well, that's because you cheated. I'm never paying you at all for that.
Oh, you know me too well. All right. So this episode, traders, is all about debt. Now, you might think to yourself, well, how does this fit into something like the Trading Psychology Podcast? Well, we're going to get there, but this is something that probably affects every single one of you, but in different ways. And so Rob and I are going to try really hard to attack all three of those ways. But as we do first every episode, Robert, we've started doing this recently. We need to define terms just to make sure that me, you, and everybody listening are all on the same page. So on our handy little outline here, we have written three different types of debt. We have the first one is credit card debt. Now, I always pay my credit cards on time. I didn't always, and things really got out of hand. And so I've been on both sides of this equation. Now, I know in the United States, Trump just put out, and this is not official yet, from what I understand, he's trying to cap the amount of interest on credit cards, assuming you don't pay them on time, to 10%. I don't know how well this is going to fly. I don't know what this is going to do to the banks, but to me, it's like, well, if you at least pay the minimum payment on time, this isn't really a big problem. What say you?
Yeah, this is never going to happen. First of all, there is no mechanism for the President of the United States to dictate to private companies what they can do with their business. So I think right there, it's just not ever going to happen. But let's say it did happen. All that's going to happen is that credit's going to get a lot less available, and hardly anyone's going to be able to get a credit card. And that's going to cause real problems because a big bulk of the U.S. spending is done by people holding revolving debt on credit cards. It's not going to be good for the economy. I know it's one of these things that sounds good and it sounds wonderful, but when you really get into it, and I read a couple of articles about this, it just have how bad of an idea it actually is. It will tighten up credit. It will make it to where the people that need credit the most, they're not going to be able to go to a credit card for it. So where do they have to go? Loan sharks and payday lenders that come out at like 30% a month. So it's a bad idea, in my opinion.
Yeah, something like this, I'm almost positive would have to go through Congress anyway. But the point remains is that credit card debt in the U.S. and I think worldwide right now is at all-time highs. People always talk about how prosperous we are because the airports are always full. Turns out I would be willing to bet that most of those people are just like, F it. I can't pay off anything, so we need to go on a vacation, so we're just going to use the credit card. And if things get higher, who cares? What's the difference between being $25,000 in credit card debt compared to $28,000? Let's just throw caution to the wind. I feel like that's where people are at right now. And well, in my opinion, on this aside, this really is a problem because unless there's some kind of debt forgiveness that comes up anytime soon, these people are going to have to pay the piper at some point, right?
Well, that is what happens with debt. And as we get into this episode, a recurring theme is going to be that debt is simply an accelerant of your financial picture. It's just an accelerant, meaning if you use it and it works out, it's great. If you use it and it doesn't work out, it's terrible. So yeah, it's really just an accelerant. And so when everyone has a job, when everyone has an income, it's easy to pay off those bills. And it's easy to carry those credit card interest rates and keep paying the minimum because, hey, you've still got your job. The problem is when the economy slows down and you no longer have your job, then you are in real trouble. So it's just an accelerant. And I want everyone to remember that as we go through this entire episode, is that debt isn't positive or negative. It's just an accelerant of the underlying condition.
All right, but we're 5 minutes in and we're still defining terms here, and that is my fault. I need to move on here. So you have credit card debt, which may or may not affect you, regardless if you have a lot or a little. But even if your credit card debt is under control and your payments are under control. The majority of people out there, especially in the West, still have loans on their home or their car or a business loan. So even if you have one side of the debt under control, there's always going to be that lingering debt on the other side. So I just want to bring that up while we're defining terms here. And then Rob, you had added one below talking about, some, especially this as this pertains to some of our listeners, you might have margin debt and you had margin/prop firms. What exactly did you mean when you wrote that down?
Anytime we talk about debt, it's when you're borrowing someone else's money. And whenever you're borrowing someone else's money, there's a cost. There's a cost. And I love to write this as an owner of a prop firm because I love just to really talk frankly. And when you do join up with a prop firm, there are costs to that capital. It would be wonderful if we could all just get access to any capital we wanted and there's no cost, but that is not reality. It's like, hey, let's get a credit card with no responsibility. You can never, get in trouble by ever using it and there's no interest. Well, that doesn't exist. So when we use things like margin through our brokers and our brokers allow us to go on margin, that's given freely. That's given very easily as long as you qualify for a margin account, which I don't know anyone who's ever been denied a margin account that didn't have the minimum balance. That's just given freely. And it always has a cost. It always has a cost. Again, with margin debt, there is, margin interest that's going to be eating away at your returns. If you're with a prop firm, there's going to be monthly fees. There's going to be other things where, again, it's eating away. So we really have to really think about, is this debt positive or negative for me? And that's really how we want you to take a look at everything in this episode.
Well, I'll push back a little bit on the margin side as far as a Forex trader goes, because with Forex, if you're not trading with margin, it's not even really worth trading unless you're just sitting there with $500,000 in your account. So your average person, especially somebody starting up with a prop firm, they're going to need that margin. So isn't that just kind of an accepted hindrance that you just have to deal with?
I think an accepted expense. Let's just take a look at something like buying a house. Or let's not even go buy the house. Let's go to your first car that you need to buy. Most people, when they go buy their first car, they don't have enough money to buy a decent car. And so they're going to buy that car and it's going to come with debt. There's going to be debt saddled to it, and that debt's going to have an interest rate and there's going to be a cost to it. But do you need that car to get to work? Do you need that car to get to places to where you can then make way more money than that debt costs you? The answer is yes. So I think you need to take a look at debt as an expense. It's simply an expense of doing either business or doing things in your life. And the big question is it good or bad? What is it doing for you?
Okay. So now that we're finally out of the defined terms portion of the podcast, I wanted to move on to the thing that I say a lot on my other podcast. And that is when I talk about compound interest. And I wish more people understood this. Your average person has no idea. But Einstein himself even said it. Compound interest is the greatest wonder of the world. What he left out is when it works in your favor. When it's working against you, which it does in the case of debt, it can be absolutely debilitating. Imagine if you had the biggest wonder of the world, but not on the right side of the equation, but on the left side of the equation, and you were constantly fighting this every day of your life, not including the fact that your fiat currency just never buys the same thing it bought the day before. I mean, that's really, really tough. And I want to illustrate that before we go forward, because I think you and I both might have different opinions on how to handle debt. But this to me, I think if more people really understood this, there would be a lot less people in debt, or at least that would be not as an alluring proposition for somebody right off the bat if they understood this math.
You're exactly right. If you really understood the math, you would really work on getting to the right side of the equation. And in this podcast, we have talked so many times, and I know it, me especially, and I've tried to be really clear as, look, the game of money is really simple. Everyone needs to go out and work, unless you were born wealthy, which not a lot of us were. So the rest of us, we need to go out and work. You have to take some of that money and buy assets that go up in value. Then all of a sudden, you're getting the interest working in your favor. You're getting 8% a year here, 12% a year here, 15% a year here, and it's working for you. And at first, it seems small. But I agree, Patrick, when you said, I wish everyone understood this. I remember learning about this in school and putting it in the calculator and being like, oh, that's pretty cool. You don't really understand it until you've lived it. Like when you make 10% a year on $10,000, that's $1,000. That's cool. That's great. That's really cool. When you make 10% on 10 million, that's really cool. That's the life-changing money. It's the same 10%, but you've got to get up to that big stack of money for compounding interest to really change your life. So everyone's got to start at zero. Everyone's going to start off at the bottom, but everything you can throw into assets, eventually when you get to 40, 50, 60 years old and you've got that big stack and you're earning 15% a year on it, oh, it's life-changing. But on the other hand, if you're working and then you're overspending and then now you've got debt payments, so you're not even keeping up with your income that you're bringing in, but now you're falling further and further and further behind because you have these extra expenses. It's such a debilitating and destructive process.
And what Rob says is 100% correct. And because it's correct, if you're 22 years old listening to this podcast right now, for example, my advice to you right straight away would be, look, I know everybody says, oh, your 20s are where you're supposed to go broke and make a bunch of mistakes. Ha ha ha. Well, seeing as how it sucks so bad when you're in debt and you're young, and it becomes completely amazing when you're older and you've got things figured out, why not do what you can to get to that point as soon as possible instead of just pissing away your entire 20s? What do you say to that argument, Rob?
If you talk to any older person who is not where they want to be financially, and you ask them, do you have any advice for me in my 20s? I already know what advice they're going to give you. I wish I would have started saving earlier in my life. That's the only advice I'll give you. I promise you. So take that advice. Just start. Just start the process. Start the cycle. I know it starts small. I know it starts at the $100 here, $100 there. It grows over your life.
All right, so there's other follow-up questions we can add to that, but I want to get to those just a bit later. Now, I know we're bouncing it back and forth a little bit here, but when it comes to the loan debt we talked about, like home, car, business, things that affect most Americans, Europeans, I know like in the Middle East, it's not as much of a thing because of the usury laws they have in their religions and things like that. But for most people listening to this podcast, getting a loan for something that's normally going to be out of your price range up front, like a home, like a car, for people who start a business, I personally don't have any debt. That's my one biggest superpower. And I made sure I did that as early as I possibly could. And we'll talk about that in a moment. But for people who live in the normal world, like Rob Reinhold, like what are the percentage rates on things like a home loan and a car loan nowadays? What are most people contending with right now? I kind of want to get an idea of what we're up against here.
I think right now the average for a car loan is like 8% a year. The average mortgage, 6% a year. Average credit card is 29%. So these are all really, expensive expenses. Now, look, I know not everyone can just go pay cash for a car, pay cash for a house. Your goal is to someday be able to do that. I have not had a car loan in 15, 20 years, and it's great. It's fantastic. And we drive our cars for a decade or more. And you know what? It's such a smaller expense than having to carry that. But in my early years, I absolutely had that debt, and it was just something that was cost of doing business. But your goal is to have no debt. That's absolutely a goal you should have.
Well, and one of the biggest reasons for that is, this is a psychology podcast, is just the psychological strain it can put on every single day of your life. And I know this because I've been there myself. I kind of want to talk about, it's obvious there's going to be psychological strain there, Rob, but what are some of the things that are more possible now? Like, what are some things that have a greater probability of happening if you have, just crippling amounts of debt affecting you every single day of your life? What is somebody like that more likely to do? What are they more likely to think when it comes time to making decisions? And they shouldn't really be thinking this way. A normal person wouldn't think the way a heavily indebted person would, right? Like, that's kind of what I want to get at here, because I feel like the majority of people listening to this right now do carry some debt. And as we often do on this show, we identify the problems first. We identify the symptoms so we can be aware of them, because if we're not aware of them, we can't fix them. So this is my roundabout way of asking you, Rob. Somebody who's in debt, what might they do that a person with zero debt would generally not do?
You already gave one example where you said that someone was, $25,000 into debt, and they say, well, why don't we go on that $3,000 vacation? Anyway, what's the difference between $25,000 of debt and $28,000 of debt? And so what happens is it puts you in this mindset that you'll never get out of it. So why try? Because you look at it, it seems it's like such a big hill to climb. And so then you never start. We've all been to a point in life where we have a big challenge in front of us, and we know it's going to be tough, and we know it's going to be a fight, and we know it's going to be a slog. And because of that, you delay actually taking action because it's just so overwhelming psychologically. And so I think what's going to happen is someone that is in debt, they're going to delay getting out of debt because they know how painful it's going to be. They know how uncomfortable it's going to be. Hopefully everyone knows about a guy named Dave Ramsey. I'm not saying I'm a huge Dave Ramsey fan, but anyone that I meet that talks to me about debt and wants to get out of debt, I say, go check out Dave Ramsey. Go do everything Dave Ramsey says. Do everything he says. And then after you get out of debt, then maybe don't do exactly what he says. He's not the greatest in investing advice, even though it's solid advice. It's solid advice. He's not telling you to do anything stupid, but you can do things better. But everything he says about getting out of debt is great. And every Friday, at least on his radio show, he has an episode where people who did it call up, tell the world their story, tell the world how they got out of debt, how much debt they got out of, and then they all yell freedom. It's awesome. I love that moment so much. And so I would say to anyone out there who is in debt and you're unhappy about it and you want to get out of it, which should be all of you if you're in debt, then take action. Do something. And I promise you, in a month from today, you'll feel a little bit better about your situation. And I promise you that a year from today, you're actually going to be pretty damn proud of what you've done. Start. The psychology behind this is that you get so far behind the eight ball that you say, why try? Or it seems like it's such a big deal that you delay the process. Just start now.
Yeah, and before Rob, you get a little ahead of me as far as the solutions portion here. I'm like, no, there's still some problems here that I want to really hammer home, because I can say this for a couple different ways. One is kind of the way you just talked about, to where you're like, you just have this like existential dread to where you're like, well, what's it matter? I'm in mountains of debt or I'm in mountains and oceans of debt. There's no difference. That's a really depressing way to live almost, because that just ensures that the problem is never, ever going to get better. You will get to a point to where you just absolutely will never be able to pay off that debt ever, because not only is it a high amount, but it also becomes a high percentage too. And again, you have that compound interest working against you. That is just the worst feeling. Now, I was in this situation myself, not because I had that level of irresponsibility, but because there just came a point in time where I was so indebted and I had that compound interest working against me every single month, to where I just simply couldn't pay my mortgage sometimes. So I would have to take out more credit card debt just to pay the mortgage. And this is something a lot of people do. They take out some debt over here just to pay for this other thing over there. And that is just a creditor's wet dream. I mean, they love when people do that because in their minds, it's like, hey, it's not my problem. It's not me being irresponsible. I'm providing a service they need, but in a way, it's a little bit predatory because they're going to be collecting even more percentage points off of somebody who's already past the point of no return. And I lived in the most fun city in the world in Las Vegas for a long time. And for a lot of that time, I really didn't want to go out and do anything because it just killed me to get myself deeper and deeper in debt. Like, what would my life be if I was just in this huge hole that I could never come out of for the rest of my life? That type of strain, how are you ever going to be successful with that hanging over your head? Now, I got a bit lucky because I was able to short sell my house. That was kind of a get out of jail free card. That's something the United States government did because they realized that a lot of people were giving predatory loans, which is one of the loans I had, and I was able to get out of it. I still don't know today. I think based on the money I made, since that time, I would have been able to get out of it. But man, if it wasn't for things like that, even somebody who's been really responsible and who takes risks and who has successful businesses like me, that would have been really, really hard to get out of. Before we get to the solutions portion, I just want to kind of deeper explore. I just want to more deeply explore, what allowing this to get out of hand, whether it's your fault or just simply not your fault, what that can do to a person, how that affects every single decision they make going forward.
When you think about debt, it's almost impossible in life to get ahead without debt. Like, I don't think anyone can be born, you leave your house at 18 and you never take out any debt for anything. I don't see how you ever get ahead. I mean, I think debt is an essential tool to get ahead in life. But there's definitely risks about it, which we've talked about and we'll keep talking about. But there's so many things that are wonderful with debt, like a school loan, like going to college. All the studies show that people that go to college end up making way more than their college cost them. Now, look, I know that a lot of these studies were done 20 years ago, and I know the math is different. I understand that. But when you look at studies look at everything. Now, someone who went to school and got a $200,000 loan for an art degree, yeah, they're probably not going to make that money back. But for the most part, something like a student loan is actually a really wonderful investment, and that debt is going to pay off huge. So as we talk about debt, we're going to spend a lot of time on the negatives of debt, but I really want to spend some time on the positives of debt because I don't think the average person can ever get ahead in life without taking on debt, but you have to use it correctly. I don't see how anyone will ever buy a house without taking on debt. So again, it's all about using it correctly. And as I said, it's an accelerant. If you're doing the right things and doing good things and being responsible and being thoughtful, debt can actually be very positive in your growth. If you're doing destructive things, buying depreciating assets and buying crap that you don't need, debt can be very destructive. So I don't want to do this big scary thing about debt. Debt is wonderful if you're doing the right things.
And I wonder too, so this podcast also goes to YouTube. Any of my Middle Eastern or my Muslim listeners, if you want to go into the comment section and talk about what the debt situation is for most people there, because to my knowledge, it's very, very different because interest on debt is considered usury in a lot of Muslim cultures. So talk to us about if it exists or how essential it actually is in that culture. I would really like to know because that's a total difference in culture right there to where we think that it's absolutely necessary for life to where you have other cultures that almost just don't do it at all. Do you have anything to say to that, Rob?
I'm really hesitant to say anything on something I don't know a whole lot about, but I do know that they have just a different way of borrowing money over there. So if you wanted to borrow $100,000 and then pay $10,000 of interest, you can't do that. But what you can do is borrow $110,000 and the person gives you $100,000. So I know there's ways to get loans without interest, but I should just shut my mouth now. I don't really know what I'm talking about.
Moving over to the ways debt can help you. Now, we want to be very, very careful here when we talk about this. There is a time and a place, and I don't know for your average person if there really is a time and a place to take on debt. But again, you guys have to understand, I'm very anti-debt, to where Rob actually sees the sunny side of it. In a lot of ways, I just don't even walk that path. So Rob, I'm going to turn most of this over to you because this is something you know more about. But there are ways, apart from just getting a loan for college or something like that, which we can have that debate whether in 2026 that's a good idea almost ever. Maybe there's a few, but there are other ways out there, and a lot of people talk about creative ways to leverage and arbitrage debt in your favor. Now, most of these people already have lots and lots and lots of money. I've noticed this with people who talk about this little strategy. But is there a way for the average person to use debt to their advantage in a low-risk way, possibly for the purpose of helping to eliminate the debt they have? That's what's really interesting. Seeing as most people do have debt, would it make sense to take on more, but if the math is right, maybe use it to their advantage and help trim that negative debt down? You would know much more about this than I would.
Oh, Patrick, you are opening up such a rabbit hole for people to go down.
Let's go.
I'm going to start off with just some basic ones, and then I'm going to get into some pretty complex things. Obviously, this isn't a podcast about how to do any of those things. One of the things I've done in the past is back in the day, they were giving 0% balance transfers or cash advancements from credit cards. This was back in, from 2008 to 2015. They would send you these checks literally every month in the mail, like, hey, just write this check out. And it's 0% for 18 months. Now, look, it had like a 3% fee in the beginning. So if you were borrowing $30,000, that's going to cost you $900. But that's going to be $900 over 18 months. So you have to figure out, okay, what is that as far as expense? And then I would make some hard money loans, Someone says, hey, I need, $30,000 for my business. And I say, okay, you've got to secure it. I need to, get a lien on some of your assets. And I would do that. And then they'd pay me back and I would make a profit. So things like that. What you really need to look at is just something called ROI. ROI, return on investment. If there's a positive ROI, good job. If it's not, bad job.
Okay. Well, again, you just described rich people stuff. Your average person doesn't have $30K just to give to somebody who needs it.
No, but that money came off of a credit card.
Okay. So that 0% credit card, does that still exist in modern day? Is this applicable advice for 2026, or is this something that's no longer around?
It's not as generous. I've seen some like 2.9% or 4.9%. Or, hey, you can do it for 6 months. They're still out there. You could absolutely still find those.
Okay. So I've also seen things like what Michael Saylor did with Bitcoin was very interesting. And people have also done this with precious metals too. Given the fact that fiat is so trash, especially long term, we know that long term it always loses its value over time. And then there are money alternatives which do nothing but gain over time. Michael Saylor is really good with this, spending a bunch of his useless fiat and getting a bunch of Bitcoin, especially early on. And that's why one of the reasons why he became so rich and really accelerated his wealth over time. And so this is something you can do at a very, very low rate. And this is something that your average person nowadays, with all the instruments available, they can do this themselves. Would this be something you recommend your average person do? Because for me, the reason I've never really gone this route is a lot of the options that are out there just seem uncomfortable to me because I don't know a lot about it. It seems like I really don't want to cut my teeth and make a bunch of mistakes on something that I just don't know a lot about. But I can certainly spend money and buy gold and spend money and buy Bitcoin and have that type of arbitrage. Or I can borrow against the Bitcoin I have. That's another type of arbitrage out there. I'm not sure how much you actually know about this. Maybe you've never really done this yourself, but people have asked me over time if they should do something like this, because I always tell people never get a loan to trade. You're only going to make it worse because of all the psychological factors you have working against you. But are there better ways for people who really are desperate to get out of debt, but just need a way they can use debt in their favor to do that? Again, for your average person, is something like I just spoke about a good option? Do you have another option that might be more suitable for your everyday person in debt? Where do you stand on this?
All right, great question. And if, again, the question was, if there's someone in debt, should they go out and try something big to get out of debt? And the answer is no. That's how people get in worse debt. There's only one way to get out of debt, is to spend less than you make and have to put the extra money you have towards your debt and get out of debt. Could someone go, instead of paying off their debt, go to Vegas and put it all on black and they win black so they double their money and then they pay off their debt? Sure, that can happen. And you know what? If that happened to you, well done, you're dumb, but it worked out. But schemes and things like that don't work out. If you are in debt, you have to get out of debt first. So what that means is you need to have a positive monthly cash flow. You need to figure out, if you make $3,000 and you're spending $3,000 and you've got $5,000 of debt, the math doesn't work. You can't get out of debt because you literally don't have any extra money. So for people that are in debt, the first thing they need to do is they need to create a positive monthly cash flow to where that extra monthly cash flow can go to debt. Now, once you get out of debt, then that extra goes into assets, which we've talked about several times in this podcast. But that's what you have to do. I wouldn't try any big crazy thing to get out of debt. You got to just grind it out. Now, I heard a great quote that I want to share with everyone, and I love this quote so much. And this is so true. I heard someone, I think it was on a podcast or something, say, it's so much easier to make $5,000 a year more than to spend $5,000 less. And I thought to myself, oh my gosh, that's so true. I remember the times in my life where I had to really cut and really spend less and really do without. It's miserable. And you get in this mindset that just nothing's going right and life is hard and why does life suck? It's so much easier just to go and drive Uber on the weekends and make $5,000 more. It's so much easier just to go do something else than to cut back. So I just want to share that with you. Just think differently. It's going to be easier for you to make $5,000 more a year than it is to try to cut it. And if you're in debt and you need more income, go figure it out. Go figure out how to make more income, but let's not do gambling schemes to try to pay it all off at once.
All right. Well, let me present one more thing to you then, Rob. I'm in. The debt I'm in right now is about 25% a year. It's absolutely killing me. But I know from the numbers, and I won't say since its inception, I'll just say in the last 10 years, Bitcoin averages about 75% per year, right in that range from what I remember. Again, this is how people like Michael Saylor were so brilliant. He took bad money and put it into good money. What if I just did something like that? Because I feel like if I spent all this time trying to pay down this debt, the opportunity costs I'm missing out on some of these things that give me 75% a year, it would just make a lot more sense for me to take the money I do have and put it into something that can make enough money to pay off my debt. I mean, I feel like I have a big enough sample size. I know it might go down, but if I wait long enough, it's bound to go up, right? I feel like, instead of, I have a wife and kids, I can't just be driving Uber on the weekends. I just don't have time. I'm in a terrible place right now. It's affecting my trading because I'm always tempted to over leverage. Why don't I just take advantage of opportunities like this? They're in front of me right now. We live in the greatest period of time in the world when it comes to making money. I feel like I should be taking these chances now instead of doing it the old school way. It seems like the math just maths. Can you provide a counter argument that's greater than math itself?
Yes. And let me tell you why it's not going to matter. Because if you're in debt, what it means is you haven't figured out how to manage money, and you haven't figured out how to have an income that's greater than your expenses. So let's say you go out and you leverage, you take out a home equity loan, you leverage Bitcoin, and you end up making an extra $100,000 off of that. And then you take that money and you pay off your bills. In 5 years, you're going to be in the exact same place. The exact same place, because you didn't fix the actual issue of why you're in debt, was that you don't have enough income to pay for your expenses. Either you don't make enough money or you spend too much money. It's one of the two. And if you don't fix that, I don't care. You might get lucky. Go put it all on black. You might get lucky. You'll be in the exact same place 5 years from now unless you fix why you're in debt.
I love that answer too, because it's almost a mean thing to say, hey, you're not psychologically strong enough to not put yourself in the same terrible situation again. Even though you would think you would grow and learn from it all. I really agree with that, man. You have to grind it out. Like, just because I short sold my house doesn't mean I still didn't have a lot of debt. Remember, I had to take out different credit cards just to get by during the slow times of the year. So I still had to grind and work myself out of a lot of that debt. And that character building was one of the best things that ever happened to me, because now I am so financially responsible and have been, for the past 10, 12 years. And I just don't think you can put a price on that.
Patrick, let me ask you the question. Without going through that tough period, would you be where you were today, thriving?
Not to this degree. No, because I would have taken more L's. Anybody that knows my material since the beginning of time, since I started my YouTube channel, knows that reducing the amount of L's just puts the math so much in your favor. And I don't know if I would have learned that had I had not learned what it's like to be in debt and what it's like to have yourself out of debt, and just the difference that makes on every dollar you earn going forward.
Every single person has to learn that lesson. I had to learn it. I had to learn that lesson. I got behind the eight ball as a young age, and I'm like, oh crap, this is serious. I need to figure out how to actually control spending. Once I did that, it's been fairly easy, but it wasn't easy at first. Every single person has to go through that process and figure that out before you can really go out there and take risks. Because even if you hit it big, it's not going to matter. You'll be in the same place. Figure out the cash flow game where you make more than you spend and you put the extra in investments. Just figure that out. Once you do that, then you can start to do some cool stuff. And let's talk about ways to use debt to grow faster. Here's one that I was thinking about when you said, hey, why don't I just go buy Bitcoin? Why don't I just go buy Bitcoin? Okay, how about this? How about you get yourself out of debt first? So you've done the math, you increase your income, you decrease your spending, and you now have $500 extra every month. And you have paid down your debt. So now you don't even have those debt payments, which gives you another $500 a month. So you now have fixed the equation to where you now have $1,000 of extra money every month. Now, if you look at that and you say, okay, well, I'm going to put that $1,000 into gold or silver or Bitcoin. You know what? It's going to be slow. It's going to be slow. Here's a way to kickstart that. Why don't you go buy $12,000 worth of gold? And again, how are you going to do that? Well, you can do it on a credit card. I buy gold from coin shops with my credit card, and they always say, hey, it's going to cost you 3%. I'm like, charge me for it. I don't care. Put that on a credit card, buy $12,000 worth of gold, and over the next year, you pay $1,000 a month. Now, of course, if you can get like, hey, this credit card has 2.9% for the first year, of course, you're going to do everything you can to minimize that debt expense. But let's say their credit card says, hey, for the first 12 months, it's only 4% interest. Great. Get that credit card, buy $12,000 worth of gold, make $1,000 payments every month. What that does is that speeds up the math, because you now have a $12,000 asset earning a rate of return. Whereas before, that first month, you only had a $1,000 asset earning a rate of return. At the end of the year, if you do the math of where you were, if you would have bought $12,000 on day one and got the return versus you bought $1,000 of gold every single month, the returns are much, much larger. So there's great ways to use debt to get ahead, and you just have to think about the return on investment.
All right, so slow down there just a little bit here, Rob, as I want to officially, I guess, we've already talked about a couple ways, but officially transition into the solutions portion of the podcast. One of the key things you said there, Rob, was after you already pay off all of your debt. So my biggest question, as somebody who is very debt averse to somebody who is more accepting of debt, my question to you is, should the very first thing every single one of our listeners should be focusing on right now is paying down their debt? After your basic expenses are taken care of, should that be your very next focus? Not so much on the making money part, but a focus on getting rid of that negative compound interest that is going to just continually be an albatross around your neck up until the time comes where you get rid of it.
So the first thing to do, even before that one, Patrick, is you got to fix your cash flow picture. Like I said, you got in debt because you spent more than you made. Now, when I say spent more than made, a lot of people say, oh, someone's out there buying all these designer handbags they can't afford. I'm not talking about that. I'm talking about life. Like, hey, your car went out and you now have to drop $800 for a repair that you weren't expecting. Like, shit happens. I get it. And it's tough. So until you fix the income versus expenses thing, it doesn't matter. It doesn't matter if you pay down your debt because you haven't fixed the problem. That's the first thing you have to fix. Then, yes, you take the extra money you have and you pay down that debt. And there are mathematical ways to do it the fastest. There's something called a debt snowball. I don't have time to get into it. Look up debt snowball. Go into ChatGPT or any AI, list all your debts and say, I have $300 a month to put onto debt payments. Tell me the fastest way to get out of debt. And it's going to tell you, pay this one off first, and then pay this one off next, and then do that one next. It's going to tell you the mathematical way to do it. So yeah, fix the problem of the income statement, and then do the mathematically correct thing when it comes to paying off debt. Because if you don't do it right, I've seen the studies of people doing a debt snowball versus not. It takes this person would have gotten out of debt in 36 months to 12 months or 15 months. It's amazing if you use the right kind of math on, it's called a debt snowball. So that's my advice. Fix the equation and then take all the extra money you have and do the mathematically best process to pay down the debt. And then once you get to zero, then all of a sudden you've got extra money that you can invest in assets.
That's a really awesome solution. I've never even heard of that. But if there's a faster way to do it, without taking on any extra risk, that's something people should be looking up right now. No, that's great. And if you feel like for some reason that you're not really winning by doing this, you're just simply not losing, well, no, you are, because as we all know, if you're a follower of my channel, we win by not losing. Mark Cuban said it really well. He says, if you have 23% debt and you eliminate it, that's actually a 23% gain. And that's not just a one-time gain. That's every single year, because you no longer have that 23% working against you. Again, I cannot stress this enough. Compound interest working for you is tremendous. Compound interest working against you is horrific. And the sooner you can get that off the books, the better you are. Now, if you have something like a home loan or a car loan, you're always going to have some percentage working against you, and that's fine. The next step is like Rob said. Figure out ways to have it work in your favor to more than offset the stuff that's working against you. One of the ways that I always tell my people on my other podcast, Rob, is to, everybody's going to have some cash. All of that cash should be working for you. Unless you're going to need it that month, put it in something that gives you yield somewhere. You can do this through bond funds, and bond funds exist pretty much on every single stock market. You can get anywhere from 3 to 5% on almost every currency out there right now, in some cases more. Or there's plenty of good options on the blockchain from very respected companies where you can do the exact same thing. Compound interest working for you, even if it's small, is still compounding, and it gets a lot bigger. I've explained this to people at first, and they don't think it's very significant. I'm like, well, on the surface, it's not. But when it compounds, it gets much, much bigger. And if you're doing it in other places, not just your cash, then it's just that much more. And you would be amazed how much this, pardon the term because you've already used it, how much it snowballs in your favor. And you can make up so much ground in so little time.
One of the things that always drives me crazy is when I talk to people and they tell me how much money they have like in their checking account. And when people have large balances in their checking account, it drives me crazy. I remember my daughter was making some pretty good money and she showed me like how much she had in her checking account and how much she then had in like her high yield savings account. And it's like she had 95% of her money in the checking account and almost nothing in the savings account. And I'm like, what are you doing? You're literally just losing free money. It's free money. Like, just simply move it from here to here. Here you get 0.1%. Over here you get 3.1%. Like, and if you need it, it's still there. It blows me away that people don't have like, the same thoughts that I do, that, you always want to be optimizing that cash. You should have the bare minimum of what you need in a checking account. And actually, I don't even think you need that, because if you've got a credit card with zero balance on it, you've got spending power. If you have an emergency come up and you got to fix your car, you got to do something, it's right there. It's right there. You should be having all your cash working for you all the time, period. It drives me crazy, so I'm going to stop my rant. I'm over.
Well, no, let's actually keep going just a little bit on that, because, you and I are money people. So in our mind, we can't understand how somebody would not do something so obvious. But I can tell you why I think a lot of people don't. One, again, they don't feel like that number is significant enough to even get out of bed and hit a few keystrokes on their computer. Two, we can't sit there and pretend like there is absolutely no risk involved in doing that. There is. It is microscopic, but it is there. And so I think what your average person might think is, well, it took me a long time to get this money. This is all the money I have. If I lose it, I'm completely screwed. For that small percentage, I just don't feel like it's worth the risk to move my money from here, where it's nice and safe and cozy in the bank doing nothing, over to there, where there is always the chance that something could collapse or something calamitous could happen, and I could lose everything I've worked so hard for. What would be your response to something like that? Because I guarantee you that is the inner monologue to most people when you bring something like this up. And in a way, I kind of get what they're thinking. I get the ethos here. I don't agree with it, but I at least get it.
I can understand it as well. But here's the reality of life. If you live your life in a scarcity mindset, you're going to struggle financially. I can guarantee you'll struggle financially. If you live in a abundance mindset, you're going to do so much better. And it's just a mindset. You could do the same things. You could do the exact same actions, but one person is living scared. They're living worried. They're worried that it's not going to be enough. I might lose it all. If you live your life like that, number one, you're going to be unhappy. Number two, you're not going to take risks. Now, yes, you may not go broke, but I have met thousands of people. I'm telling you, thousands of people in my life who have gone broke once in their life. They all tell me, best thing that ever happened to me. Because guess what? They got up, they learned from it, they grew, and they're doing fantastic. Now, look, there's probably someone who did fail and went broke and was so devastated by it that they never recovered. Okay, that probably happened. But going broke, if you are living your life to not go broke, man, that's a miserable life. I'm sorry. It's why I tell the story, Patrick, whenever I'm worried about money, I get $100 bills out of my bank and I start giving them away to people. Even though I'm worried about money and I want to hold on to money, I give them away because I want to have that mindset that, hey, you know what? It's okay. There's a lot of abundance here. I want to be very grateful for what I have. That's going to lead you into a so much better financial place and a mental place in your life, just living that lifestyle.
And I'm so glad you brought this up because I've talked about this as well, especially in the times we live in now. It's almost like I felt like in the 90s you could get away with this, but things are just so much different nowadays. For those of you who do not listen to my other podcast and you mostly just listen to this one, I had an episode where I brought something up that was very damning. It was very alarming to most people, but it's true. We spoke before about how fiat currency does nothing but lose its value because of the way we dilute it and we print over time. Well, since 2020, where we threw $7 trillion at the economy simply so it wouldn't crash during the COVID years in the United States. And the odd thing was every G20 country did this same, not named Russia, did this exact same thing, worse per capita than the United States did. So if you're in any of those countries, this is probably going to apply to you. And if you're in some other countries, this is going to apply even worse. But I went to ChatGPT and to Gemini both to cross-reference this. And I said, okay, since 2020, how much purchasing power has the United States dollar lost? And they both gave me about the same answer, about 25%, which is a lot. Horrifying to know that in such a short amount of time, we have lost a quarter of our purchasing power. But I noticed they were both using the CPI as their guide, which anybody who follows finance, Rob and you both know how inaccurate the CPI actually is. They don't account for home costs or fuel, which is like the top two, or I think it's food and fuel, two of the top, expenses that everybody has. They just don't even count that. They massage those numbers over time to make the end number look better. So I said, okay, I know of this guy named John Williams in Australia who owns a company called Shadow Stats. And what he does is he attempts to find the actual correct number. Now, I don't know how correct he is to the high side or the low side. I don't know. But I said, eliminate the CPI from your equation and substitute John Williams's numbers in. Now how much have we lost since the year 2020? And the answer came more to 65%. Horrifying. And it makes a lot of sense. I don't know about you, Rob, but on social media back in 2019, I didn't see anybody talking about how expensive everything is and how they can't pay their bills and how they can't buy a house and all this. But I see it all the time now. So it wouldn't surprise me one bit if those numbers were correct. The point I want to make with this, and it ties to your point, is nowadays, even though we were raised to think otherwise for some reason, the riskiest thing you can possibly do is to not take any risk at all. So like we said earlier, the first thing you need to do is to get rid of that debt. You cannot have compound interest working against you. That's absurd. It doesn't matter what you do from that point on. That must be step number one. But from there, don't be so risk averse that you don't take chances and you don't understand the percentage points mean a lot going forward, because the absolute worst thing you can do is to curl up into a ball and squirrel your money away, because little do you know, you're losing it, and you're losing it at a high rate almost every single day nowadays in 2026.
You're so right. I mean, if you want to guarantee that you lose, don't stay in ahead of the inflation curve. You'll fall further and further behind, and that's just another compound interest working against you. As things get more and more expensive, if your income isn't going up by at least that amount, you're screwed. You're screwed. How are you possibly going to survive if your income isn't going up enough to cover the rising cost of inflation? You can't fall behind that curve at all. You can't. This, as Patrick said, The compounding interest working against you is devastating. You'll never make it.
So, to wrap it all up, I know this is probably the longest episode we ever did, but it was worth it because, well, one, we haven't talked to you guys in a while. We haven't done a show in a while, so it's long overdue. And then two, if you don't get this right, the other 98 episodes we did almost don't even matter. So it's so important you figure this part out first and then move on to step two, which is how can I make more sustainable money through trading and through investing, going forward. So I almost wish I would have thought of this episode earlier, but at least we thought about it now. Thank you, everybody, for listening. I hope you put it into practice if you haven't already. And Rob and I will both see you in the next episode.